Welcome to the Bekaert Tax Beat, a conversation about tax that matters.
Welcome to the Tax Beat podcast. Today we are talking about two powerful tools for real estate owners, developers, and designers: cost segregation studies and the Section 179D energy efficient commercial buildings deduction. These provisions in the tax law help real property owners take deductions for certain building assets in the first year they are placed in service. My name is Michael Ronsky, member of our National Tax Office, and I'm here with Sarah McGregor, also from our National Tax Office. And Sarah, I'll let you introduce yourself to our lovely listeners here.
Hi, all. It's good to be back here with you for our Tax Beat podcast. And as usual, my spring March Madness basketball bracket is completely busted. So, oh well, maybe there's always next year.
That is the optimism we like to hear. Pleased to welcome to the podcast our Marty Karaman, partner and leader of our firm's tax credits and incentive practice, and two others joining him from TCIA, Daniel Hurtado, who leads the cost segregation team, and Andre Kahn, who focuses on energy credits and incentives. And if you three wouldn't mind taking a moment to introduce yourselves, that'd be great.
Yeah, this is Marty Karaman. Thanks for having me. Again, this time during March Madness, I have no interest in sports because I'm mostly just focused on what's going on with all this tax stuff we have at the moment. I'm the leader of Tax Credits Incentives Advisory, and I am joined by two of my esteemed colleagues. But overall, the group of TCIA, we're focused on performing R&D studies to the extent you may be investing in R&D or developing software. We focus on the purchase of or construction of commercial real estate. That's specifically like 179D and cost seg, which we're going to talk about today. We also focus on and work with companies that are buying or constructing a new manufacturing facilities. That's QPP, which is a new incentive that came out in the big, beautiful bill. We also work with companies that invest in alternative energy or just maybe looking for a new site as they're expanding. So that's me. I'll turn it over to Daniel and Andre to introduce themselves.
Thank you, Marty. This is Daniel Hurtado, and I lead our cost segregation practice. And cost segregation is something I've been doing for about 30 years now, and like to work with engineers and other tax professionals around real estate.
Thanks, Daniel. And thank you all for joining with us. Sarah, Michael, it is good for us to be here. I'm sitting here in sunny Houston, Texas, and both my Houston Cougars and Daniel's Longhorns are out of the March Madness tournament. So I'm hoping this chat lifts our spirits a bit.
Indeed, it will. So thank you all for those introductions. Jumping into our conversation, let's go ahead and start with cost segs. Can you guys give us a high-level recap on what a cost segregation study is and what has changed around them recently?
Yep, absolutely. I'll take that, Marty, if that's okay. So cost segregation study is actually, sad to say, specializing in it for 30 years, it actually predates me. So cost segregations have been with us for a while, but it's an opportunity for taxpayers that are investing in real estate, whether acquiring or constructing property, to review the cost associated with those items and identify areas where they can accelerate deductions. So at the end of the day, what we're dealing with is actually a tax optimization of tax deferral, or we're identifying items that qualify for bonus depreciation, or a couple of new areas that we're going to cover today with qualified production property and QIP, and look at areas where we can accelerate additional deductions that are remaining in the real estate account, or 39 years in this case.
That's great. So are we only talking about new construction and new buildings, or does this apply to an acquisition of an existing building?
No, it's definitely not just new buildings. So there's always an opportunity to go back and review historical fixed assets. There's opportunities that we're involved with as well with bonus depreciation, and looking at, about a decade ago, Sarah, taxpayers were really focused on repairs and maintenance. And so now with 100% bonus and some states decoupling from bonus depreciation, we have opportunities to re-review the tax register and find older properties that may have not been touched at a certain point in time, or also, definitely touch on new construction as well. So it's never too late, I would always say, with cost segregation.
And the goal behind this is really just to push deductions into that first year, get that bonus depreciation on it, instead of dragging it out over a 39-year depreciable life. That's the real goal here?
That is correct. Always looking to accelerate the deductions, and with bonus depreciation, it makes it into that first tax year really being the most optimal.
Right. Should speed up cash flow from saving taxes in those early years versus waiting out depreciation.
Yes.
Great. Thank you both. Let's go ahead and shift over to Section 179D, the energy efficient commercial buildings deduction. What exactly is it other than a fancy sounding name, and who benefits from it?
Gotcha. So, Marty, I'll take that one as well. So, this is a 20-year-old tax incentive for commercial building owners and designers of tax-exempt commercial buildings. And in 2026, this deduction is worth up to $5.94 per square foot in tax deductions for qualified buildings. So how a building qualifies is we'll take your plans and specifications and compare them to an ASHRAE standard from 2007. So that's 90.1-2007. And if your building is more energy efficient than that baseline ASHRAE standard by at least 25%, then it could qualify for a tax deduction.
So again, this is not just new buildings. It is for making improvements to existing buildings as well, Andre?
Correct. So this is for newly constructed buildings, as well as any buildings that have impact or renovation or expansion to the HVAC systems, the interior lighting systems, and the building envelope systems.
And Andre, this is Marty. Maybe it's a good time to talk about the One Big Beautiful Bill and why it's important to look at this now as opposed to later, or maybe act on this now, if you don't mind adding a little color there.
Yeah, so the interesting thing about the One Big Beautiful Bill is that Section 179D, as reported by the One Big Beautiful Bill, is among the highest impact incentives for commercial building owners, designers, and subsequently local communities, while being one of the lowest federal budget line items for building incentives. So right now, the One Big Beautiful Bill has sunset any Section 179D eligible buildings that don't start construction before June 30th of this year. So if your building does not start construction before June 30th of this year, then Section 179D is out. So Congress basically took a large stroke to any traditional energy efficient incentives and told us we can do two things about it: absolutely nothing and like it. Right. So that was a bad joke, but there are a few things that commercial building owners and designers can do while we wait for an extension. I've been in this ecosystem for the last decade or so, and we've been here before. One of those things is if you're a commercial building owner and had depreciable basis during a new development, or have completed upgrades to your interior lighting, building envelope, or HVAC systems. We can look back as far as 2006 for unclaimed Section 179D deductions. So one of the benefits there is, much like a cost segregation study, we would use a Form 3115 for commercial building owners to update the depreciation so that you can take that in the current year's tax return. Now, if you're a designer, you still have eligibility to claim the current buildings that have broken ground before the June 30th cutoff of this year, and any eligible buildings that completed construction in the last 3 years. So, there's still some time for buildings that have been completed, but we would definitely encourage you to go ahead and get started with construction before that cutoff.
So, Andre, when you talk about designers, you're talking about the architects, the engineers, folks like that. Is that right?
Yeah. So architects, engineers, and design build contractors. The IRS specifically enumerates all of these folks as qualified parties to the Section 179D deduction. And what defines you as a designer is anyone who creates technical specifications for the installation of energy efficient commercial building property.
So this could apply to those that are doing work for, say, schools or government buildings or other tax exempt kind of buildings, and not just the commercial building owners that are out there.
Yes, Sarah,
Right.
this is Marty. It applies to the owners to the extent you are an owner that in that particular case when you're a taxpayer. But if you're not a taxpayer, say you're a not-for-profit, you can actually allocate the deduction back to the designer. And so we work with a number of nonprofits and the designers there in that particular case, those architecture and engineering firms. So we have a lot of owner-occupied 179 studies, and then also a number of them on behalf of architects and engineers who are getting these allocations allocated back to them.
So obviously a lot to consider here, guys. You've done a very good job of explaining it all, and I'll be the bad guy and further complicate the picture. So in addition to the June 30th cutoff date that we must keep top of mind, but this incentive is also tied in with prevailing wage and apprentice program requirements. How do building owners meet these requirements in order to maximize that per square foot deduction that you were speaking of, Andre?
Michael, great question. So two things. Prevailing wages and apprenticeship hours, at least how to track them, has been the thorn in many of our construction and design clients' sides for the past few years. And it was really a big question for a while because it was not mentioned in the latest audit technique guidelines on, how they be taking a look at prevailing wages and apprenticeship hours. So there is a new form, 7220, that is used to retain labor data, compliance, and even prevailing wage and apprenticeship hour corrections here in 2026. So that's number one. Number two, considering the cap of $1.16 per square foot. Let's say you don't pay a prevailing wage or you don't have apprenticeship hours, you still get up to that $1.16 per square foot. Now, it's not uncommon for us to come across a 500,000 square foot or 1 million square foot industrial facility and entertainment venues that could still yield as much as $1.6 million in tax deductions. So there's still a lot of opportunities, even if you don't pay those prevailing wages.
That's great. Thank you, Andre. One thing I want to make sure that our listeners are aware of is the fact that these deduction accelerating mechanisms are not mutually exclusive. And I understand that you all offer a very coordinated approach, pairing these incentives together to maximize the advantages for our clients. What are the benefits of taking such a coordinated approach?
This is Marty.
Go ahead, Marty.
Well, I'll just say this is Marty. I think that the benefit is clearly it's maximizing the current deductions that you can take. So when we look at cost seg for owner occupied and commercial buildings, we will look at 179D as well. One complements the next. Again, we're looking at bonus depreciation and if you do or do not qualify for that as well. But then we're also looking at whether or not you are creating a manufacturing facility, say, for example, and you can take advantage of the qualified production property regime as well. Costing is kind of like the baseline to understand the building, and then we'll understand if there's a QPP available, and we'll get diagrams to understand whether 179D on top of that can provide additional benefit.
So Daniel, there's been a lot of changes in the tax law with One Big Beautiful Bill. What changed for cost segregation studies and for bonus depreciation?
That's a good question, Sarah. And unfortunately, or actually to the benefit, unlike 179D that has a sunset provision in the One Big Beautiful Bill, cost segregation and bonus depreciation got an enhancement. So on one side of it, we brought back 100% bonus depreciation. We also made that permanent. So from a tax planning perspective, we have more consistency and preparedness because prior to the One Big Beautiful Bill, actually bonus depreciation has been on a 20% declining adjustment since 2022, and it was set to phase out after 2026. And so now we have 100% bonus depreciation permanently. Secondly, we have a new class of property, which is identified as QPP or qualified production property. So now for manufacturers that are involved in new construction, we have an opportunity to identify areas that are specific to qualified production activities and be able to take an additional bonus depreciation adjustment for eligible property that is QPP.
So Daniel, who are the best taxpayers to take advantage of the combined 179D and cost segregation studies?
So the combined taxpayers are definitely those that are capital intensive, right? So if you're buying or building or contemplating purchasing a facility, those are always eligible projects to look at and identify which components qualify for either bonus depreciation or 179D energy efficiency. But also because we've been talking about not just new construction, but maybe taxpayers that have added additions over the past several years, it's always a good opportunity to revisit the tax register, depreciation register, and see if there's opportunities to clean up any missed deductions or evaluate missed properties that might have not have been evaluated before.
Well, Marty, we've been talking to some of your team here on what they do and the expertise they bring. You've written a lot about the value of using services from a full service accounting firm versus going to a specialist or a boutique kind of firm for these kinds of incentives. What are your thoughts on that? Why Cherry Bekaert versus another firm?
Yeah, I think there's two real reasons. One is we don't charge on a contingent fee basis, so there's no potential incentive for, if it's a Cherry Bekaert or an accounting firm, for the provider to look for additional benefits from wherever they maybe don't exist. And so the other, I think, is that we take the time to look through the entire return to the extent we get access to it to look for additional benefits. So we're not just looking at cost seg, we're going to look at cost seg plus 179D. We're also going to look for the QPP, but we're also going to look to see if there's an R&D benefit potentially available to you, or potentially some other energy credit or state credit and incentive. So I think it's a more holistic approach. And generally, I find on behalf of our clients, the pricing is more reasonable for them.
All right. That sounds like a good place for us to wrap up. Let's see who's got final comments. Andre, we'll start with you. Any final comments?
Yeah, Sarah, I just wanted to add that, a good chunk of our advisory responsibilities is education and awareness. So if you're listening and you think your business or someone in your circle of influence could qualify for any of these incentives, feel free to reach out to us at costsegplusenergy@cbh.com. Be happy to talk to you.
Excellent. Daniel, your thoughts?
Yeah, Sarah, I'd kind of second what Andre said. At the end of the day, what we're talking about are some tax incentives that have been around for a little while. The big thing that's changed is that we have an opportunity to reevaluate, and we have some dates to be aware of. So although these projects seem like they'd be eligible at a base level, there's definitely some criteria and requirements that we need to meet. So as Marty mentioned, the benefit of our group is that we will investigate all opportunities and validate whether it's applicable to you before we actually move to an engagement.
Fantastic. And Marty?
Yeah, I think my final thought would be 2026 seems like the year of the cost seg. Everybody seems to want one. Bonus coming back has really incentivized people to take a look at this again. And also with the cutoff coming on 179D, I think there's some beginning of construction that has been accelerated as well. So it's just contributing to an environment where we're talking to more clients than ever. And we would love to talk to anybody who's listening to this.
Yeah. I would say with the rise in construction costs, in remodeling costs, in building renovation costs, the cost seg study and a 179D analysis are going to be very helpful to clients, to taxpayers to manage their cash flow needs as they get into these projects and are trying to push forward cash to either pay down loans or finance this transaction. And this is a great way to do that. So Michael, I'll turn it over to you for last thoughts.
Well, I think you all nailed the technical. So my parting word of advice would be for those of you whose brackets are busted to take solace in the fact that baseball is finally back. So I want to thank everyone for a great conversation and for joining us today. Cost segregation and Section 179D continue to provide building owners with improved cash flow from accelerating deductions, but the window to maximize one of these strategies is closing. So please reach out to us however we can help you with that. Sarah, thank you so much for co-hosting with me today. Thank you, Marty, Daniel, and Andre for sharing your expertise. And thank you, our listeners, for spending time with us. We truly do appreciate it. Just to provide a quick disclaimer, we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. If you found today's episode helpful, please be sure to like, share, and subscribe. And that concludes our discussion today. Thank you all again, and we look forward to seeing you next time. Bye-bye.